Ladies and gentlemen of the crypto space, we're live on a Wednesday, June 28th at 12:01 p.m. It's a nice title for the stream. It's a concept I've been talking about a lot lately. It's expectations. And crypto has the tendency to outperform, as we've discussed, as Raul has discussed. It outperforms uh, NASDAQ, and NASDAQ outperforms the S&P relative to liquidity. And that's why we look at liquidity so much. So I wanted to very much focus this stream on expectations and tie it into cash flow and dividends and talk about those things which we played around with for all these years and the general public never really had access to the concept of like a cash and carry trade, catching a spread at 10% a borrow rate and a 20% a lending rate is a spread of 10%. Now these spreads are not historically available in traditional finance, but they're available in crypto. One, we all played around with stuff like this. And two, you quickly realize that 10% on 100 grand, 10 grand per year, calendar year, is not something that most people have the comfortability to sit with, be it the size of the portfolio, be it the expectation or the temptation to try and outperform. Now, the biggest harm that people have done, and they constantly do, and we see it all the time and time again with the meme coins, is that folks are trying to outperform in a market that outperforms. So the most important thing in markets is survival. You don't leave a market. There's no getting in and out, in my opinion. It's imperative to stay in a market, and you want to navigate the cycles and have higher lows and higher highs with both portfolio valuation as well as cash flow value measured on probably a weekly basis at this point. And as long as you do that, you're surfing. You're riding a wave, and that wave is trending up with regard to liquidity availability in the system. So everything we've learned over the last years and everything we inspect from a data perspective with regard to systemic liquidity composition and directionality, you just want to surf the wave. And if you're surfing the wave, you're heading in the right direction. And surfing the wave doesn't entail you need to significantly outperform. Everyone wants to. You get tempted to. But if you lower your expectations, you significantly increase your capacity to survive and stay on the wave instead of wiping out. So many folks do leverage trading, with perpetuals and what have you, and futures markets, and they take on too much risk, and people are ultimately responsible for their own financial self-harm. And if you lowered expectations, sorry, phone call. My phone doesn't stop. And if you lowered your expectations, you significantly increase your capacity to survive, and your portfolio would have been up. If you doubled your portfolio between 2020 and today, in historic terms, that's tremendous. You don't normally, that's not normal. And obviously there's a capacity significantly more than double, 5, 10, 15, 100x, 50x on the money. But if you chase those types of returns, you're significantly decreasing your capacity to survive. Okay, so there's two ways to engage with markets: capital gains, which obviously leans towards one's desire to significantly outperform. And then there's a more traditional value investing methodology, which we've talked about over the years. I think I mentioned it. And that has like Buffett-esque written all over it. It's the concept of business ownership and the concept of cash flow. And the hardest thing to do when adjusting to that type of mentality and methodology is, one, you probably need more capital for it to be fulfilling, to feel like you're getting the bang for your buck. And two, you have to be ready to lower your expectations. If you could get 20, 30, 40% per year, that's monumental from an enterprise cash flow perspective. That's unheard of in really traditional finance, especially considering the reality that crypto outperforms liquidity. So crypto outperforms Nasdaq, and Nasdaq outperforms the S&P. Therefore, by underperforming in crypto, you're going to massively outperform linear traditional finance, where the S&P basically trends along with systemic liquidity. And you're not getting these kinds of dividends in the mega cap techs. And with regard to Nasdaq, it's been so few assets that have held QQQ where it's at. So there is no dividend opportunity. There is no cash flow opportunity. It's just not even reasonable from a traditional financial perspective. You have to be in venture capital to own a significant percent of an enterprise at a low valuation, and for it to go 10x on the money, a $50 million valuation goes to a half a bill. That's very much a successful enterprise. But to get in traditional enterprise on a $50 million valuation, a capital raise like that, you are in that business or associated with someone in that business. So that's not happening. So that's something that's interesting from a crypto perspective that's often criticized from like an accredited investor standpoint or a traditional finance qualification perspective. You could buy anything. It's permissionless. And obviously that's riddled with bullshit and scams and meme crap and garbage and tech that may be good, but the best tech isn't necessarily the best investment. So I would remind folks that it's imperative to eliminate options and choices when interacting with markets. That's how you simplify the equation and look for reasons to invalidate an investment opportunity. And as you expand that list of reasons to invalidate things, you are significantly simplifying the amount of work that you potentially have to do, the amount of thought experiments, the amount of considerations. And you'll quickly find that you're probably going to be disappointed, meaning there's a great opportunity, but you can't get the great adequate position size. And you're like, shit, I have to invalidate it as a consideration. And that's very disappointing. So the most important thing with regard to lowering expectations is to get comfortable with the reality of disappointment. The biggest burden or battle that you deal with as an investor is the emotions associated with these things. And it's a lot. It's a lot to see someone else do a 50x on the money and you did a 2x, or you break even, or maybe even down. And then you're like, oh, I got to do, you FOMO. And then you're like, I got to do something. I got to figure out the hot thing that's going on. Where's someone doing like a borrow and a lending, and then they're lending the LSD, and then they're borrowing against that, and then they're leveraging and lending more and more, and it increases the complexity. So there's plenty of ways to increase complexity of those types of cash and carry type implementations. But now you're increasing your responsibility and the amount of work you have to do. So my equation over the years has been, what's the simplest thing I could do to attach myself to liquidity, to extract cash flow from these systems that I speculate will continue to exist in the future and will grow as the liquidity flowing through DeFi markets grows. So there's plenty of new tech. I mean, look, the Mavericks hot right about now, and Grail on Camelot on Arbitrum and Velodrome on Optimism. Okay, so why have I invalidated those as considerations? Optimism basically has very little to no liquidity, and we could see that. Where do I have that data? Let's pull that up. I have that here. Let's pull that up. Let's pull up the liquidity data. Here it is. Here. I have so many screens. Give me a second. Bear with me. I'll be put over to the main screen. Stablecoins. All right. So how have I invalidated potential interesting opportunities that are relatively smaller? You're able to own more of it. But guess what? Look, if you're getting 20, 30, 40, 50% on an L2, on Arbitrum or Optimism, and you're getting 20%, 30, 40% on mainnet, it's the same thing. So What's the rationale in that something has more potential on a network that has significantly less liquidity than mainnet? There's $616 million in optimism. For me, that invalidates almost anything on optimism. Why? Relative to other networks, there's significantly more liquidity. With liquidity comes churn, volume, potential appreciation. Go over to Arbitrum. It's $1.76 billion. It's like 3 times the size of optimism. But compared to mainnet, you're at $69.54 billion. Still a negative sum game. Might as well note that. But that's how I invalidate things. I have a critical, uh, you know, list of things that allow me to invalidate potential considerations. And this is kind of like, Sailor often says there is no second best. You can have a better tech come along. It doesn't mean much considering lendiness, time in the market, brand, adoption, consumption, usage, so on and so forth. So better tech does not necessarily mean a better investment. So where are we with regard to cash flow? Cash flow, it doesn't matter the system. What's pertinent is the amount of cash flow and the potential for it to survive and its growth trajectory. So that's like, for instance, if you own a house and you're getting 5% APR, what does that mean? Your rental income from owning the house equates to 5% APR. Or you own a pizza shop that costs you $1 million to set up and you're making $200,000 a year in income. That's 20% APR. So everything reduces to principal and revenue that's generated from that principal, which can be talked about in terms of literally APR, return on capital on a yearly basis. So you can't just look for one protocol, one piece of tech, one enterprise that does something different. It doesn't matter that it does something different because financially it still reduces to the same fundamental reality of APR. How much do I buy produces how much cash flow. So in that regard, it puts literally everything on the same, it normalizes literally every type of investment on the planet. Doesn't matter whether it's traditional or cryptocurrency related. You're evaluating things quantitatively, financially, from an APR perspective. And then the question becomes trajectory, lendiness, which is the likelihood that it's going to survive. And that's why liquidity is so important, so significant. If you're deploying to locked positions on L2s, like let's say Velodrome is interesting. I was solidly, and I had a place for me when it still does from a technology standpoint. But what did I just say? Better technology doesn't mean it's necessarily a better investment. So Velodrome, let's say you have a locked position that's producing 25, 30, 40% APR. Who gives a shit if it goes 1,000x on the money? It's a locked position. You can't liquidate it if you want to. So by allocating to a cash flow narrative, or according to a cash flow narrative, you can't even capitalize on it from a capital gains perspective. So you've invalidated that contemplation, that means of engaging with the market to capitalize. It's not real. So unless you're willing to hold it spot, if you're holding an asset spot, now comes in the entire conversation I've been having recently about what is cash and alternative monies. I'm not a fan of holding things spot. I'm not a fan of owning assets liquid, as in they could be sold as an investment. I like to think of anything that could be sold for dollars as a dollar equivalent, which is literally the definition of a dollar equivalent. That's why they talk about bonds in terms of a dollar equivalent in traditional finance. So this is helping me navigate these markets with a rigorous framework. Anything that's liquid that can be sold for dollars is usable, consumable as a dollar. If I could sell a crypto asset for USDC and transfer the USDC to a debit card in 3 minutes, that's cash. Cash is money. and money is consumable as for means of purchase. So what does that mean with regard to holding spot assets? It invalidates almost all consideration for me unless I consider it a money. And I've talked recently about like Ethereum and Bitcoin and stablecoins, and that's what I consider monies for various reasons. I'm not going to digress too much into that. So with regard to cash flow, we've normalized everything and anything, traditional finance and crypto, as measured by APR. So if that's the normalization, what you have to do is find things that are cash flow positive, disintermediate that cash flow, and give it to you quantifiable in terms of the APR value. And then your next job is to eliminate things. You have to eliminate. There's no reason to own things out on the risk curve. If you can get a solid 20% on the money with a protocol that's very likely to exist in the future, what's the point of getting 20% on the money? Because you normalize all this shit on something that is less likely to exist in the future. This is like what Saylor says. There is no second best. There's only which one is the more likely to exist in the future and is most likely to continue to give you the APR that you're looking for. So this is why I come back to my definition as that there is no second best as curve. So Uniswap has all the volume, but there's zero cash flow. So from my investment standpoint, Uni is useless. It's worthless. It's invalidated. And I just have gone through the list of things, and they're just invalidated, invalidated, invalidated. Everything gets invalidated. There is no second best. Now, I'm no sailor, and I question the things that I hold true, and that's important, being rational. But I don't see an alternative with regard to what is most likely to exist in the future. You need critical immutability. Which protocols have touted that as its core thesis? Frankly, there's only two on mainnet that have touted critical immutability as like a core tenet, and that's like Tapioca and Curve, like critical immutability. Even Chris Black talks about Curve. And so that's interesting. So look, there's going to be an APR associated with interacting with Tapioca. What if it's 20%? And what if let's say your APR interacting with Curve is 20%? So frankly, that does eliminate, by this rationale we're talking about, Tapioca as a capital allocation, unless there's another reason to allocate other than APR, because obviously Curve has been in existence longer. It has its lendiness, its trust, there's governments looking at using it. So it's far in the lead. It's entrenched. It's critically immutable. So there is rationale for allocating to something that produces a similar comparable APR, because we normalized all these assets. And it's not, and it is the second best, or that kind of concept, and that's diversification. What happens if something happens, something unexpected? You must prepare for the worst. If you prepare for the worst, you're prepared. So it's in that regard, diversification is important. To have multiple systems that are literally 20% APR, so they're all doing the exact same thing, but you have something else, just in case something happens that is unexpected. Great tech. I'm very excited for Tapioca. Come on. Liquid cross-chain on layer 0? That's crazy. That's crazy. But if you normalize APR versus APR versus APR versus APR, that's the only number that matters, because this game is for you. You're not investing in a company because you want to be part of a community. Don't give me that community bullshit, that whole stupid narrative that goes around on social media. I'm part of a community. I'm part of a group. No. This capital management is a personal game. You have money. You want to invest it. You want a return on your damn money. That's it, period. Nothing else. How much are you paying me? I don't give a shit if your asset's going to go up in price. Fuck you, pay me. pinned tweet. So hopefully this simplifies the equation and helps you make these kinds of decisions. You want the fastest horse. You want the horse that's most likely to continue running in the future with the most lendiness that produces 20% APR. So if a new tech comes on, a VE, MAV, or whatever is going to happen with Maverick, we don't know what's going to happen with liquidity, with volume, with cash flow. Let's say they carve out a niche. I mean, look at what's going on with Balancer and Aura. They sure as hell carved out a niche in the currency recycler regime implementation arena, so to speak. Can Maverick do something like that? And what happens if they do? They produce 20%, 30%. What are they going to produce? APR. Normalize everything. They're all the same if you look at things from an APR perspective. Also great. So they carve out speculatively that they carve out that kind of cash flow and you're making 25%, 30%, whatever it is. So it's no different. I don't give a shit that it's a different protocol. I care about the APR and how much it's paying me. Because, oh, I chose to own the fancy new protocol versus something that's old. I'm not part of a good enough community. I'm not taking advantage of an opportunity of something new. So invalidate that. It's not new. New and shiny doesn't mean shit. What matters is how much you're getting paid weekly and is it likely to continue. That's the equation. Diversification is important just in case something is invalidated or something unexpected occurs. And you must distinguish between investments and cash. Liquid assets should not be considered investments. So that's, I'm just expressing with vigor my perspective. Everyone obviously is welcome to interpret accordingly and take all my framework ideas in their own, absorb them, assimilate them. But that's what I'm stating. Spot assets are cash. You could convert it quickly into $1 and spend it at a store. And if you could do that in 3 minutes, it's basically cash. So, food for thought. Capital gains is not cash flow. That's you're working. It's literally active income, or I would imagine. It's not passive income from like a tax reporting perspective. So you don't want to work. You want passive income. You want passive investing. That's the holy grail of capital management. Everyone, a lot of folks on social media talk about, oh, you have to time the markets. Timing the markets is better than time in the market. And a lot of the billionaires, they've always said time in the market. That's like what Buffett touts. And then traders and hedge funds will be like, you got to time the market. You get in and out. You can make big numbers, big multiples. All that narrative shit will drive you nuts. And that's why I've done what I've done and normalized everything. And APR, fuck you, pay me. Simplify the equation. Differentiate between investments and cash. Invalidate. You should literally be like, yeah, that's not worth it. It's on optimism, producing 25% return on the money. And then compare the liquidity. And what's the potential for optimism to have more liquidity than mainnet? I don't know. I don't think that is a reasonable argument. I think mainnet is just, it has the finality. If you're a multinational bank and you're going to do a $10 billion transaction, why the hell are you going to engage with anything other than mainnet? You're not. So all the big money is going to be on mainnet, and you'll have the small transactions. So then maybe you could say maybe all the smaller transactions in aggregate financial activity, non-big actors, would be more than mainnet. I mean, there is an argument that optimism could have more liquidity over time than mainnet. I don't want to bet on that. I want to bet where the damn liquidity is now. And to me, liquidity speaks. There's a reason the liquidity is on mainnet and nowhere else. Everything else is just the smaller actors or the hungry predator trying to capitalize. And those are not markets I want to engage with. I want to engage with markets that are comforting, calm. I don't have to think about them too much. And that's why I love locked positions. It invalidates everything. You can't sell them. That's great. It's a purchase. Why is that discomforting? You make purchases all day long. You buy cars, you buy shit at the grocery store, you buy electronic devices, you make purchases all over the place. Except in this instance, the purchase pays you on a weekly basis. Why is a purchase so discomforting to so many folks? But it's not so many folks because there's a large community of lockers that lock for 3.56 years on average. For a reason, because they see this maybe in a different lens, what I'm talking about, but they see this, that it's a purchase. You keep extending your lock, you're getting protocol cash flow, you're getting vote rental cash flow. It pays you. The purchase pays you. Raul's in the house. Bill, hey, Cap, hope you are doing well. Been taking a look at the O2 tokens, and I know your stance on mainnet being king. How irrational is it to take 0.5 to 1% position in ARB optimism in this market? That's fine. So from a speculative standpoint, you want small bets to turn into big things. I've always said 1% to 10% changes everything. So, that's not going to jeopardize your survival. You're going to probably want to hold it spot because 0.5 to 1% isn't going to do shit from cash flow perspective. So, but now you're acting contrary to, a spot liquid position, which I define as cash, as an investment. So that's a capital gain strategy. So that's fine. You have to define your execution narrative for yourself. That's all subjective. So that's fine. And you clearly have thought about the sizing. 0.5 to 1% is not going to bankrupt you. So if you have eliminated protocols and validated investment considerations, and you found something that you think 1% of the portfolio may become 10% of the portfolio, that's the type of thing that significantly changes the structure of a portfolio over 1, 2, 3, 4, 5 years. And those are the things you kind of want to do. Even I engage contrary to what I've said this stream at times. No one is ever 100% consistent. Everything we're talking about is always malleable. Always a conversation, a self-reflecting conversation about what you're going to do and why you're going to do it and what are the considerations. Hope that helps. Papsy, another stream. Yep. Midweek. Kaysen in the house. Joshua, Daniel, Noah, did you notice the BIS announcement regarding Kurt Finance? Yes, I saw that. Okay, so all right, I pretty much talked the entire stream about is anything else a considerable allocation? Now, obviously, what Michael does with his ownership and his borrowing has considerations, risk considerations. He didn't liquidate. So he capitalized by borrowing, which is what anyone in traditional finance, any large stakeholder would do that wants to express alignment with what they've built as an enterprise. They want to capitalize. That's what humans want to do. They can, and they don't want to have a negative impact on the business they've built. So generally speaking, all of those things were achieved with Michael's behavior. Period. So, if governments, where are governments going to allocate to? Are they going to build their own networks? Are they going to fork code? I mean, they could do all those things, and that's a consideration. Like Ethereum mainnet just becomes invalidated because BIS, CBDCs, everyone uses that. All right, great. Now that's why you have to have traditional financial investments and you diversify. But I don't think that's the case. I think peering through all the bullshit that can be spouted by politicians, I think there's something significant to the scale and scope, size, liquidity available on mainnet. What has been built thus far, I think, is meaningful, and I think it continues to grow. So I sleep well that I don't think Ethereum is going to be invalidated. Daniel, anyone else having sound problems? Sound should be pretty good. Let me check my settings real quick. I know by the time I read these comments, it's late, but I might as well check. I might as well check. Oh, Sound Pro. Yeah, well, okay, I'm going to adjust it there. I'm not going to blow your eardrums, but I think that should be a significant difference in sound. So hard to maintain sound controls. I have so many configurations to do. Hope that helps. David, hey, no, I love the stream. Big fan of the new backgrounds. Yeah, I'm having fun with the new backgrounds. Stream's quality seems off. I hope that fixed it. Curious on your thoughts between investing in a group of Web3 seed rounds versus short-term capital gains trading on chain. Do you see more opportunity in either? I've had my fair share of seed rounds. I've had my fair share of capital gains. Everyone has to be on their own journey and figure out how they want to execute and define their rules. And that's just not where I'm at. So that's obviously why the content is what it is that I talk about. But I don't generally, I think that's a great way to significantly outperform. But we come back to what I just talked about. You're trying to outperform in a market that's going to outperform everything else relative to liquidity, directionality. So that's something to consider. Um, Seed round, you're max risk. What if it fails? What if it doesn't? I have seed rounds that have gone to basically zero. So, don't put all your eggs in one basket. Look at what Bill mentioned earlier in the comments, 0.5% to 1%. And 0.5% to 1% of your portfolio into a seed round might not be enough bang for the buck, and that should help you invalidate considering it as a potential allocation, which leads to exactly what I said earlier, that you're going to be disappointed. And the hardest thing to learn with regard to executing capital management is to get acclimated to being disappointed. It's a lot. Brian, howdy. Crypto Jake. Yes, but cash flow has been growing for Velo, which has attributed to its price appreciation. 40% APR and a 10K. Well, the size of the investment doesn't matter. What's pertinent, as I've discussed all stream, is APR. APR. APR is meaningful. Do you expect it to grow? Is it going to grow proportional to liquidity on optimism? It's the capital, the price of Velo doesn't mean anything because you can't sell it. It's locked. So you have to invalidate even thinking about it from a capital gains standpoint. So 40% is 40%, whether you're getting it on Optimism, whether you're getting it on Arbitrum, Polygon, mainnet, 40% is 40%. Normalize all of these assets based on APR. I hope that helps. You could also sell the NFT if you wanted. So, yeah, you're going to take a fat haircut. So, as you mentioned, bear in mind, all that sounds reasonable. That increases the complexity of capital management, which is why I love locked positions that are completely illiquid, that you cannot liquidate, because that simplifies the equation. And I don't want to have to think, do I buy this? Do I sell this? Am I holding it? Is it going in the right direction? That's complicated. I have so much shit I got to deal with between everything in my life. I focus every ounce of my effort on simplifying the equation. I want to buy things that pay me, and I speculate that they're going to continue to pay me into the future. And I speculate that that payment will grow into the future relative to liquidity. And it doesn't matter which asset it is. I just want the asset to continue to exist, which is why I always talk about critical immutability. That means everything. That means the software is going to continue to exist. So if the software is growing, it's built lineliness, it's going to be there in 5 years, in 10 years. That simplifies the equation significantly. Hope that helps. Dan, I'm having a hard time deciding between focusing just on CVX or continuing to have both CVX and Aura. How do you sort through this type of deliberation? So, well, bear in mind we just normalized between all these protocols based on APR, so that's all that matters. So, this is actually relative or a deliberation I'm currently having with myself because I have the Aura position that you guys know about from Discord. It produces an APR that's meaningful. It's entrenched. It's built. It's carved out a niche very nicely on mainnet as a currency recycling regime, which is quite fascinating from an achievement perspective. That's a big deal. it's very likely to exist, and they're expanding to other chains. They went to Arbitrum, and so I have more reasons than less to relock the position than to liquidate it. Is heading in the right direction. It produces an APR that's comparable to vote rentals on other currency recycling regimes, be it Velo or whatever, or Curve. So it does the same thing from a financial perspective. It diversifies, so diversification is meaningful. It's actually really hard to diversify relative to the fastest horse. So, like, if you're going to diversify away from Bitcoin and that's your fastest horse narrative, Ethereum is obviously your diversifier. It's not Sol, it's not Matic. That's significantly out on the risk curve compared to Ethereum compared to Bitcoin. So, it's a hard one, Dan, but I hope that helps. You want to have some diversification. Bear in mind, it's hard to have diversification unless your primary position has reached a target. Define targets. And you probably shouldn't exceed targets. You really need a big argument to exceed a target. We talked about my target size for the current position on Discord, and that was last year. Early last year, I think, if I recall correctly. And we talked about the Aura position size. I'm like, I'm going to wait. I'm going to take this much of a position, and it is going to be what it's going to be. And that's where I'm at. And I don't see any reason to adjust the portfolio considering anything I see in market structure, market data, market directionality. Hallucians in the house. Oh, if someone's buying assets to sell in a bull market, how is that considered cash? Because I'm defining a spot asset. I have X amount of Ethereum as cash because you can use it as cash. So I am presenting the argument how I'm simplifying the equation. I don't want to treat it as an investment. I consider the Ethereum and Bitcoin that I snagged a little bit of and USDC as cash. If I need to buy something, I'm going to buy it. I'm going to spend my cash. I'm not going to restrain myself from liquidating these assets. That's my cash position, just denominated not dollars, but liquid instantaneously with dollars and spendable as if it were dollars. So that's why I'm defining it as the cash position. Liquid assets that can be consumed as cash. So that introduces a great complexity with Bitcoin. If you're getting income from enterprise ownership and you're allocating to cash position, USDC, Bitcoin, Ethereum, as I define it, now you have a reason not to sell Bitcoin at a depreciated price or Ethereum at a depreciated price if you bought at a relatively high level. So that increases complexity. Now, bear in mind, this is why you do have to look at technical data. And for me, the technical data is the directionality of liquidity. So if right now, the liquidity and directionality indicates upward price action for all of our cash positions, Ethereum, Bitcoin, not USDC, but you get my point. There's no reason to expect things to continue further to the downside. Now, bear in mind, directionally upward volatility with commercial real estate and student loan repayments are very much on the table. So you can have a big fat dip of 20, 30% and it gets bought because the liquidity is there elsewhere in other parts of the world even possibly. So the directionality will continue upward even though the volatility has a meaningful event. It's just the liquidity's there. It'll come from somewhere because these are assets that are outside money. And that has a very meaningful narrative for the very thing I've been talking about with regard to my commercial bank experience. Anon, thanks Noah, you're very welcome. M, is your lock position VE curve? Yes, that is a mainnet position. Aura pays 2x CVX. Yes. I cannot rationalize a curve derivative position based on my current mentality. So Aura, I would compare to, or cash flow, I would compare to my V curve cash flow. That's just CBX and whatever derivative it is. Even the new ones that look really nice, they're pretty and they seem innovative. I can't justify it compared to base layer because I don't need it. I think base layer is going to grow massive. So the whole point of the stream is adjusting expectations. No. Oh yeah, I'm on the right here. So expectations for curve. Expectations for curve one are, let's go out to the weekly. One, I see this as one heck of an inverse head and shoulders. So I don't expect down from here. I expect up from here. I don't expect asymmetric appreciation. Oh, I'm on the title. I don't expect asymmetric appreciation for these assets for a curve. Meaning the big ones like Bitcoin, 30, 40, 50,000%. That's crazy expectations. Expectations are off the charts, horrible for a lot of the crypto community. What if you get a 5x in 5 years, or this goes to like $6, $7, $8 by 2030? For me, I'm like, great. If I'm getting 30% on that, 20% on that, 10% on that, that's certainly meeting my expectations for this position. Can't sell it. Got 4-year locks that have to be extended in perpetuity to access the cash flow. So adjust expectations, survive, and you're attaching to the way crypto markets respond to liquidity, which is basically asymmetric. So you could literally underperform the shit out of the crypto markets, and you're outperforming everything else. That's crazy. Crypto, raining bribe revenue. Yes, from both. That's correct. That's correct. Paladin, that's an interesting product. The Warlord, very interesting. Derivatives. I like the derivatives from a base layer maxi that I am because the derivatives are federation components and they're participating in the currency recycling process. So they're sucking circulating supply, sterilizing circulating supply, and that means everything. So that's what I like the derivatives. Keep going, and it attracts different market actors to get involved, whereas they'd shy away from a base layer capital allocation. And these federation components are effectively attracting people, and that's why it's working. Mad TV. There's a Saturday Night Live reference in the cover screen. Dan, thanks. That's quite helpful. I keep moving the goalpost up with CVX and FXS accumulation goals. Well, I understand why you're doing that. I mean, come on, look at what Frax is doing. The potential is enormous. It's exciting. The scale and the scope is massive as a financial product, a suite of financial products. So I understand. I appreciate that. It's not easy what we do. Define rules, define limits, define expectations, and lower your expectations. And you will survive to see 2025 and 2030. And if you're in the market now for 2025 and 2030, I think it's going to be nice. Hallucian, I just put my ETH cash flow from yield into GLP while I wait to see how much this market plays out. I'm earning a nice but modest yield with muted upside and downside. Yes, GLP is interesting. Bear in mind expectations. Look, if you're getting 40% on 10 grand, just as long as your expectations are there that you're making 4 grand a year, you're not making money. You're not making big money. It's not becoming a big portfolio unless I mean, compounding at 40% is kind of crazy. That would change everything from like what the eighth wonder of the world, as Einstein called it, compounding interest. So, but that's an expectation. Redefine your expectation. At least know what's likely to come. If you're compounding at 40% per year, you're going to be really cool in about 10 years if that rate of return, that APR, is maintained. Expect the APRs to dilute significantly. That is definitely a reasonable expectation. Hallucian, also, I have a volatile exposure, which I think is likely in the near term. Yeah, sure. GLP should respond nicely to that, as well as many other products. The volatility I expect to be there. I expect serious volatility, but I also understand volume. So from a volume perspective, I just see this as a decent structure from a curve perspective. Curve is not really telling us where the crypto markets are at. I think really right now Bitcoin's in the driver's seat, as Bitcoin dominance talks about. And if you look at the volume, all this activity since the beginning of the year, all of 2023, 6 months, has been much lower volume than we're at now, and we blew past the largest volume spike of the year, which was literally this past week, last week. That was the largest volume of 2023, and we're above that. So all these people that bought in, there's not much profit to be made. So what's their rationale for selling? To understand market directionality, you have to understand the psychology of the people making the markets. If the only way this is going back down is if the people that got in with this massive volume of activity are either breaking even or taking a loss. Where's the rationale in that? Who's selling shit at a loss? That makes no sense. At least from an overall market standpoint, individuals do that all the time. Buy high, sell low, shit like that. But as a market as a whole, markets don't buy high, sell low. That's not how markets work. So this is a very interesting technical position relative to structure, relative to price, relative to trend. And it's a double top right here, which is very interesting. And a double top has negative connotations, but I would say this is more so going to result in some sort of triangular compression or an ascending triangle type of structure. And this is an interesting volume region right here. It's very interesting. And you see something similar in Ethereum, maybe even a larger breadth of volume to a lower price point. 1500 to 1900 is big volume. And moving averages are directionally very interesting. If we go out to the monthly, you don't get as much information. But what's interesting from Ethereum and the monthly is the TWAP. This will be the second month of a confirmation of resistance flip support. So it took 18 months. I've been looking this over. 18 months to anyway, all these months to get back to the time-weighted average price, and now we pushed above it, and we're holding it as support. As Confluence suggesting directionality reversal to the upside, or it becoming a price point of support. And it is literally, this wick to the bottom one is huge. This is a spinning top, so that's directionally inconclusive. But this is approaching like a dragonfly or a bullish hammer. Oh, this looks crazy from a candle standpoint. Candles matter. The wick being right on the time-weighted average price matters. The volume concentration here matters. Being above the 10 SMA matters. If we close anywhere above the open of the previous candle at about 1871, that matters, and that's very interesting, and we're really close. It's literally like a 50-point spread from here. If we close in 2 days, 8 hours at 1900, we get another piece of confluence from a candle standpoint, and that matters. And Bitcoin has its positives as well. Same thing, time-weighted average price. Bitcoin is structured better as compared to Ethereum from a monthly TWAP perspective. Above the 50 SMA, above the 10 SMA down here. No direct interaction with a candle wick and moving average price. So it's not like TWAPing occurred. Maybe there was more volatility and push below it from a 50 SMA perspective. But structurally, moving average-wise, volume-wise, this is a positive position to be in, especially after all the depreciation we had. After all the depreciation we had, who's left to sell? Hope that helps. Last question, I'll wrap it up for today. If Curve USD continues on a good trajectory and Michael does not get liquidated, there's no way in a roaring full-on greed bull market that Curve will not hit 10, 15 bucks at least. Now, bear in mind, that's a relatively modest crypto expectation. Crypto does countless multiples more than that. Or, it can. So that's modest. What if it goes to $5, $10? For me, that is a modest expectation relative to what people's expectations are for meme coins to turn $1,000 into $10 million. Like, how is that people's expectations? Expectations are so all over the place. You got to lower your expectations and be reasonable and rational. So, Raul, that makes sense. So if you're getting 20, 30, 40% right now, and the principal goes 10, 15x on the money, and your yield goes down to 10, 15, 20%, oh, you just went 10x on the money and you're still making 10, 20%? That's crazy. So directionally, that's heading in very much the direction I want to head in from a capital management standpoint. Ladies and gentlemen, thank you all for joining me today. 27 people remaining on the stream, 12 likes. I appreciate all of you. Hit that thumbs up button. Wednesday, June 28th at 12:52 p.m. Tell everyone to subscribe. And you know the deal. After party on Discord for the most rational community in the entire crypto space. Links in the description. I will catch you on Friday. Y'all have a good one now.